Hello everyone, it's Suslov, Head of Capital Markets at AD Mortgage, here with you for our AD Weekly Digest to share most recent economic, mortgage and non-KM news. I'll start today with most recent updates on non-KM space that are going on at AD Mortgage. AD has a great set of updates coming in the next months. First of all, we're looking to add HELOC products to our line. And another feature AD is looking to introduce is the automated short-term rental valuation, which is named AirDNA, and that will allow us to evaluate monthly property rental values automatically. Turning back to the economy, it was a pretty tough week for bonds and equities where no flight to safety was to be found. Stock futures and bond market are pointing to lower prices to begin this week. Freddie Mac 30-year fixed rates are at 6.02%, and we saw a 40 basis points increase for non-KM rates in the past week. Today, average non-KM rate holds at around 7.5%, and this week all eyes are on Fed. The committee meets to decide whether to hike 75 basis points or 1%. And we're glad to have Billy here with us today to shed more light on today's rates environment. Hello Billy, how's it going?
Hello Alex, it's going okay. Recovered from a head cold. A little weak voice, but we'll work with it. Last week was all about news items and surprises. By my count, 14 economic indicators. 2 of them came in as expected. 5 of them were market friendly and 7 of them were market unfriendly. Reality is there was one number that everyone was waiting on last week, and that was the CPI number. We found out there that core inflation, which is the inflation measure excluding energy, which is incredibly weak right now, even that was, well, that index was came in at up 0.6%, expected to be up 0.3%. The headline number, which includes the soft energy index, came in up 0.1% when it was expected to be up or be down at 0.1%. So the numbers were bearish. It's an indication the Fed needs to keep raising rates, and probably more aggressively than they have been, or at least as aggressively. And aside from that number, and we had PPI and we had retail sales, but the other number that was important, I think, is the weekly jobless claims, which came in softer than expected for the 7th consecutive week. So the 2 biggest numbers showed us inflation is worse than most people thought, and the jobs market's still better than most people think. And with that, interest rates spiked up about 25 beeps for the 5-year and the 10-year. The 1-year traded through 4% for the first time since 2007. The 2 years traded into the mid 390s, which is 50 basis points above where it was in June. And on Friday afternoon, the 10-year became the last maturity to trade through the June yield crest. When it got to 349, having topped at 348.5 in June. Monday morning it opened at 351, but as I sit here today, that's the high yield of the move in the 10-year. So it's held pretty much against its old yield crest, and a bounce from here would probably be viewed as technical. And so we'll keep that in mind, and maybe that it's going to put some pressure on the yield curve, at least on the inverting of it. And going forward, as the Fed raises rates, we'll have to see if it carries the 10s and the 5s with it, and with the 10s and the 5s, we'll go mortgage rates. With that, I'll kick it back to you, Alex, and we'll see where Wednesday takes us.
Billy, I appreciate the overview. In my opinion, the disbalance between core CPI and combined CPI numbers is pretty natural, since oil went down and products currently selling in the stores still have a little higher transportation costs implied with several months price lag. And I believe going forward, we should expect core CPI number to follow CPI path and be a little lower than the previous months. Thank you everyone. Once again, it was Suslov, Head of Capital Markets at AD Mortgage with our AD Weekly Digest. Stay tuned and make sure you sign up to our YouTube channel to be on top of the most recent mortgage news, market news and non-KM updates. Stay tuned.